Hello, today I'm going to show you the difference between a stop order and a stop limit order. So these are different types of orders that can help you manage your risk. Stop order is an order that you can place below your initial entry that will help you market sell right away when the stop is triggered. One example a stop order is good for is if you're not monitoring your position actively. So if you aren't looking at it every day or frequently, it may be beneficial to place a stop order. Now let's get on to an example of a stop order. Let's say you buy shares of Starbucks at 76 for simplicity, and you put a stop at 74 down over here. The stop will be triggered and it will market sell your order whenever it's triggered. So this can protect you if the stock falls even lower to 73, 72, and so on. However, these orders do not activate during after hours movement. For example, let's say you buy at 76 and at the end of and you put your stop at 74. Right around here. At the end of the trading day, Starbucks goes to 77, so everything's good. But during after hours, there's some disappointing news, and the stock tumbles down to 74, and it hits this area right here. The stop won't be activated because it's after hours. So even if it goes lower, it still won't be activated. So let's say, for example, during this after hours beat, it goes down to $70. So this is well below what you placed your stop at. When the market opens the next day, and this is wherever this is at, if it's at $70 during the opening of the next marketing day, it will automatically trigger the stop and market sell your order. So it will sell it at whatever it opens at. Now, the stop can be great for a long-term investment or when you aren't monitoring your position frequently, like I said before, or if you just want to manage your risk differently. But stop limit, on the other hand, is different. Let's use the same scenario. You buy shares at 76 and you set your stop at 74. Now you can set a limit price for the lowest price you'd be willing to sell for. We'll set this, for example, at 72. So you bought at 76, your stop is at 74, and your limit is at 72. Now the stock you purchased went to 77 during normal trading hours, and it ended the day at 77. After hours, there's some disappointing news, and the stock tumbles from 77 down to 70. So the next trading day, it opens at 70. The stop limit won't be triggered automatically like the stop is. It's going to just wait until it can see if it goes up to 72 where you put your limit at. And the bad thing is, the negative thing about the stop limit is that it doesn't trigger automatically the next day at opening bell or whenever the regular trading hours. So theoretically, it could just keep going down and down from 70 to 65 to 60, and it still won't trigger that stop limit because it's just waiting. The lowest price you set it for to sell was 72. So basically, the stop limit is waiting for the stock to get back to the price you set the limit at. In this case, 72. I use stop orders sometimes, but not stop limits, because if I'm not monitoring my position actively, I want my shares to sell immediately at a certain price for safety. The stop order ensures your trade is executed, but does not ensure at what price it's executed. So that's the difference between the two orders, the stop and the stop limit. Hope this helped. Thanks for watching.